Good afternoon. We're the Whitworth University CFA team here to present Red Line Hotels. Through the conversion of brands as well as the transition to the asset-light model, we expect predictable revenues as well as scalability for the company, leading to higher margins and ROIC. In addition to our investment thesis, 3 things that we really like about Red Line would be management's experience and vision for the company, RevPAC's innovative technology, as well as the view of Red Line as an underdog. This meaning that Wall Street hasn't paid the stock too much attention with only a few analysts covering it. And yet Red Line is using this to their advantage by targeting fragmented hospitality segments and offering low fees to franchisees to get them to convert to the Red Line brands. With this in mind, we assign a buy rating to Red Line with a target price of $11.94, representing a 17.7% upside from its closing price on January 12th of $10.15.
Red Line has 14 hotel brands starting from economy to upscale in the lodging industry. Red Line is the 10th largest hotel franchisor in the US with over 1,100 hotels system-wide. Spread across 48 states and 4 countries, Red Line has over 70,000 rooms among franchises and owned hotels. Compared to their peers, Red Line has low number of rooms. This shows that Red Line is a subscale hotel chain, which supports the view of Red Line as an underdog.
Red Line's management team has extensive experience within the hospitality industry, most having over 25 years of experience. CEO Greg Mount joined the company in 2014 and has served as a catalyst of change for Red Line. Using his knowledge of M&As, he has led the acquisitions of Guest House, Settle Inn, and Vantage Hospitality Group. CFO Doug Ledwig has experience from his time at Four Seasons, where he helped transition them from a company owned and operated to an asset-light model. CMO Bill Linehan has experience from his time at Scepter Hospitality, where he oversaw their revenue management systems. Using these experiences, they hope to continue to market the RevPAC system and expand under their new franchise model. Within the hospitality industry, there are 6 levels or scales, ranging from economy to luxury. These are based on ADR, or average daily rate. According to Matt Murphy, president of Paramount Hotels, ADR, along with occupancy rates and revenue per available room, are the 3 main KPIs for this industry.
The segment with the highest number of rooms is upper mid-scale, followed by upscale and economy. However, if you look at the number of rooms in construction, notice that the number of economy rooms is significantly lower and being replaced by upscale and upper mid-scale rooms, which make up almost 3/4 of the pipeline rooms. In 2018, supply is expected to outpace demand, which may have negative implications on the occupancy rate, which may lead to a lower increase in RevPAR. Through statistical testing, we found that GDP and disposable income are highly correlated to the industry ADR. Expectations for continued GDP growth in 2018 may result in a positive outlook for the industry ADR as well. The competitive rivalry within the industry is average. There are numerous competitors and high capital costs incurred when starting a new hotel, which may drive up the competition. However, low exit barriers and varying market shares among the competitors may drive down the competition.
We compared Red Line with their peers in each scale. Red Line's RevPAR is in between competitive metrics due to average ADR and occupancy rates. Because RevPAR is the way to measure the effectiveness of a company's ability to balance healthy ADR and occupancy rates, Red Line's RevPAR indicates that it's in line with their peers for managing their revenue and pricing their rooms. So we believe that Red Line is capable of competing with their peers. Red Line differentiates among their peers with low franchise fee, RevPAC guest management system, and OTA partnership. We see RevPAC as Red Line's one of the biggest advantages over their peers. RevPAC helps Red Line to reach increasing RevPAR, growing market share, and boosting their revenue. This is really important because RevPAR helps Red Line to increase their franchises, which their competitors are lacking currently. As a result, RevPAC gives the biggest advantage to their franchises by increasing their profitability and ROIC.
Looking at efficiency ratios, Red Line is well below the industry averages. However, moving forward with its transition to an asset-light model, we anticipate an ROIC of 30%. CFO Doug Ledwig also gave guidance of EBITDA margins between 40 and 50% moving forward. The incremental flow-through for company-operated hotel revenue is 52%, while the flow-through for franchise revenue is 90%. This demonstrates the capability to scale within this segment. When looking at Red Line's long-term solvency metrics, we see a company that could face some financial roadblocks in the next few years. Their interest coverage ratio is 0.6, showing their inability to service their debt. There's a large spread between the EBITDA to interest expense and interest coverage ratio because the company is still being weighed down by their company-operated hotel segment. This segment has a large amount of depreciation assets, which negatively impact their ability to service their debt. Redline currently has $87 million in long-term debt, with an additional $24.4 million that is due within the next year. Their ability to retire this debt relies solely on their ability to sell their hotels moving forward.
We valued Redline Hotels through a two-part method. First, we looked at the company through a discounted cash flow model, and then further valued the company through a private market valuation to assess potential change control premium of Redline. A few factors that drove our model include increasing ADR, increasing GDP, as well as increasing margins as the company shifts to the asset-light business model. For our DCF, across our base case, upside, and downside scenarios, two factors changed: ADR growth from year to year, and the number of company-owned hotels expected to be sold within our 5 years of forecasting. For the base case, we estimated 2% ADR growth, with 11 of their company-owned hotels that are currently on the market sold within these 5 years. For the upside case, we estimated 3% ADR growth, with all 14 of their company-owned hotels sold. And for the downside case, a 0% ADR growth, with 4 company-owned hotels sold. The result for all cases are declining revenues as we see margins increase. For our revenue assumptions, we looked at a few KPIs or key performance indicators like ADR and occupancy rates. We applied the total available rooms for each of their company-owned hotels to estimate an annual revenue for each individual hotel. We looked at these same KPIs for their franchise segment. We also talked to Redline Hotel franchisees as well as competing franchisees to estimate a fee structure for each of their brands. Other assumptions, such as depreciation and capital expenditures, are highly correlated to their company-owned hotel segment. As the company sells these assets, we expect both of these assumptions to fall as a percent of revenue. Several steps that management has taken over the past few years will make Redline Hotels an appealing acquisition target moving forward. For example, the company has stressed predictable revenue streams, most notably seen through the sale of their entertainment segment, as well as their focus on flat fees among many of their brands. In addition, in November, CFO Doug Ludwig claimed the company would be debt-free within the next 6 to 9 months. These two factors, combined with an expectation of increasing profitability, will make Redline Hotels an acquisition target. We also talked to 2 past Redline Hotel executives, Ramsey Krutchnik and Jeremy Scott, and from our conversations with them, concluded that an acquisition of Redline Hotels would be a highly likely outcome for their business direction. Because of this, we valued Redline Hotels in excess of our DCF target price through a private market valuation. We estimate a buyout price of $13.93 per share. We assigned a likelihood of a buyout of 30%, discounted this for a total target price of $11.94.
We ran a Monte Carlo simulation to investigate how fluctuations in GDP would affect RLH's target price. After running 100,000 simulations, we came out with a median target price of $11.80 to support our final valuation.
The most notable investment risks for Redline would include the hotel real estate market as well as alternative lodging. In terms of the hotel real estate market, hotels are extremely illiquid assets. According to Todd Clark, a senior vice president and partner of Kidder Matthews in Tacoma, he estimates that in this current market condition, it would take about 3 to 9 months to sell a commercial property. With Redline trying to sell these company-owned and operated hotels, without these sales, there will be no payment down of their long-term debt, as well as the transition to the asset-light model will not be completed. In terms of alternative lodging, while Airbnb does not pose a threat to the whole lodging industry, it does pose a threat to subscale hotels like Redline. Airbnb's targeted demographic would be extended stay, price-sensitive guests who are typically not business travelers. Since most businesses will cover travel expenses, business travelers are not price-sensitive and will stay in upscale hotels in convenient locations, such as near airports and in large cities. In a conversation we had with Stuart Dimmel, a previous revenue manager out of Four Seasons, he agreed with this notion of business travelers not being price-sensitive. Redline hotels tend to be off the beaten path, and because of this, attract more of those price-sensitive guests. We view Airbnb as having a major impact on Redline, both now and continuing into the future. To conclude, we assign a buy rating to Redline with a target price of $11.94. Through the conversion of their brands, management's experience and vision for the company, we believe that this company is undervalued. Thank you so much for listening to our presentation, and we will now be fielding questions.
Thank you. Estimates on the, I think you mentioned 11 properties for sale. What estimated proceeds on that, and what would likely gain on sale be relative to the stated book value of those assets?
Yeah, so, well, it depends on the hotel. So anywhere from 20 to sometimes even a loss on some of their hotels, but we basically estimated each hotel based on the available rooms, and then we weighted it by available rooms as a proxy for size, and then weighted it as the starting rate for the hotel as a proxy for location. And we did that for the book value as well as for the market value. And then the difference we factored in as a non-recurring cash flow to the DCF. But
in addition to that, I might add, CFO Doug Ludwig gave guidance to all of their sales being in between about 165 to 175 million in total.
Right, and so that would be used for debt pay down?
Yes.
And then the remainder, did he have any plans or any?
The plans that he gave was going to be 100 million or so on the balance sheet in cash that they could use for potential acquisitions in the future, or just be able to.
Got it. Okay.
Have free cash.
And how are their franchise agreements structured in terms of how does the royalty system work and the duration? And
Yeah, so Redline has royalty fees which is lower than the competitors if you compare to their competitors in each scale. And so compared to the other brands, Redline offers flexible franchising, which means that any brand can start in any scale, like economy, and then they could go up to the other scales. And if we look at here, Redline is currently focusing on upscale brand, and if you look at the upscale, Hotel Ara has the lowest franchise fee compared to their peers.
And if I may add something to clarify, these fees here listed are a lot of these are flat fees. So most of their fee structures are flat. I think the only variable fees they have are with the Redline Hotel brand name and then the Redline Hotel and Suites. But these are estimated as percentage of revenue. And so it gives, by giving the flat fees to their franchisees, it gives them that ability to scale above and beyond.
great, pass it to Craig.
Can you tell me what your average franchise fee per hotel is, or per room? Either one of those.
Average franchise fee. So
The actual revenue.
for Redline hotels.
Yes.
Yeah, average should be around 4%. If we go to but it's for royalty fees. So if we look at here, we have some lower franchise fee for royalty fees for the economy scale, which
Well,
is like.
I saw that. It's a nice chart, but I didn't see what is the actual revenue received on average.
They'll receive about, depending on the brand, they'll receive usually around $50 per room a month for each of their brands. So basically, how we calculate it within the model for this, we estimated available rooms across their brands for each individual brand estimated.
In your revenue forecast, could you break that down into how much your growth rate, and is it all organic, or is there some inorganic growth expected going forward?
Yeah, there's definitely a little of both. So we took into account the increasing ADR, so as growth for that. But in terms of adding franchisees, we mainly added the ones that the hotels that they're selling. So we took that into account in the franchise agreements that are being added. They're focusing on mid-scale to upscale, so those two brands, and we expect that to really drive the franchise growth moving forward.
Well, okay, to be clear, what is your revenue growth expectation for the company?
Yeah, so eventually we'll see revenue declining as they sell off their hotels, but as they shift in the next 5 years, our projections are that they'll eventually, as revenue drops, they're marginally increasing, but they'll eventually steady. So we expect them to drop, significantly over the next few years, about 15% or so.
I noticed in terms of their most recent quarter that their company-owned hotels division did 18.6% operating margins versus their franchise division did 15.6. Why do you think that they would be wanting to get rid of the higher operating margin business and take their resources towards the lower operating margin?
So as the model scales, the franchise segment has particularly fixed costs associated with it. So as the model scales, it allows for an increased profitability through higher margins, whereas the company-operated hotel segment has variable costs associated with it. So if they can shift to this franchise model, it will increase the predictable revenues as well as eventually it will drive the ROIC higher.
Okay, that was a really good response. So my follow-up would be that in terms of their flat fee structure, do you have some concerns in terms of an economic downturn that because those franchisees have this fixed dollar amount that they have to pay back to the parent, that could create chaos in a downturn?
If I could address that question. So we're not really concerned about the flat fee structure. We're actually seeing this their only risk at this point would be adding franchisees and franchisee agreements to grow their revenues.
So when their partners get in trouble, can they defer payment from the partners, or what levers can they play to kind of smooth out the cyclicality of the business?
I'm not sure.
Can you touch a little bit about management ownership, and have they been buying? What can you give us walk through the officers? Who are big owners? What are the trends in buying shares?
I know that 23% of the shares are owned by ANA as well as Columbia Pacific. I can answer to that.
Yeah,
Yes.
but looking at the CEO, CFO, have they been active purchasers? Do they have options? Can you any
Yes.
background there?
Sure. Yeah. So the CEO as well as the rest of the executive team, they do take options contracts and they get stock compensation based on the performance of the company. I'm not sure what happened here, but we did we have some of the numbers within our appendix slides for how much they make. The CEO in 2016 took home $1.3 million in incentive-based pay above his salary.
Okay. Also, RevPAR by segment, how has that been trending relative to the competition?
I think their RevPAR has been it's been a little bit below, and I'd say Red Lion itself is kind of a little bit below the industry. A lot of that comes with them not being in those centralized locations in the middle of the cities. They're a little bit more, as Tanner touched upon a little bit during the presentation, they're a little bit more off the beaten path. They're a lot of their travelers aren't business travelers, so most of their revenue comes only during the weekends and not so much during the week. And so compared to their competitors, the RevPAR itself is a little bit lower.
Right, and the assets for sale, those are considered non-core, and some where they just don't have scale or mass necessarily.
Can you
the assets for sale. How do they make that determination? Were they just not they didn't have mass in those areas, or were those properties trending in a certain direction that was problematic?
Yeah. So the ones that they listed for sale, they let those are the ones that are most profitable and that they'll get the highest price for. Best price for. So the ones that they are not, those are in the RL venture. The ones that are not for sale, the 3 remaining ones that they own, they're waiting to become more profitable and they'll purchase those.
I got a question regarding Monte Carlo simulation. Explain to me how a Monte Carlo simulation was built into this expectation of rate of return or growth?
So how we did the Monte Carlo simulation was we looked at GDP, ADR, and occupancy rate. And so through previous statistical regressions that we ran, we found that all of them are pretty correlated to each other, and especially with the GDP and the ADR. And so we built that into our DCF by when GDP increased, our ADR also increased, since our DCF takes into account ADR of both company and franchise hotels. And so whenever GDP went up, a lot of our ADR would increase, and so would occupancy rates and whatever the correlations were between those. And so that would factor into our target price, and so it's directly built into the DCF.
Did you factor in the operating expenses staying flat?
That's time.
Thank you.